Good day, everyone, and thank you for joining us. My name is Sarah Ferreira, and I am here today with my team members, Hannah Donovan, Christian Rea, and April Upliger, to discuss the possibility of opening a new upscale hotel in the Philadelphia market. A bit later in our presentation, Christian will be discussing supply, demand, and future build. Hannah will be introducing you to the market's economic condition, followed by April, who will be covering the financial details. We will be happy to answer any questions you have following our presentation. I would like to begin our discussion today with an overview of the market's history, where the market stands today, and answer the question everybody wants to know. Would we build a new upscale property in this market? The Philadelphia market has seen a rise in the total number of upscale hotels over the past 5 years. In December of 2009, the hotel market was supporting a total of 357 hotels. Out of the 357 properties, 59 hotels, or 16.5% of the market, were categorized as upscale. Over the next 12 months, the market saw a rise in the total number of hotels in the region, and by December of 2010, the total number of properties had increased to 362. The upscale market grew at only 0.3% to 17.1%. Throughout the next 4 years, the total number of hotels continued to grow, and by the end of 2014, the total had reached 381. The upscale market rose slowly, reaching 19.4% by December of 2014. While there was growth in not only the overall number of hotels, but also the upscale market, we found the subcategory of hotels, those with 170 to 199 rooms, only had 5 properties. The current upscale market in Philadelphia includes properties owned by Marriott, Hyatt, Hilton, Intercontinental, Starwood, and W. Ascend, which is owned by Choice Hotels, and the Radisson round out the properties in the upscale market of Philadelphia. This market has seen continued growth over the past 10 years. Recently, Courtyard Marriott opened 3 properties and the Hilton Garden Inn opened 1. Although there were 4 opened, there are 2 under construction. They are the Element Hotel and Residence Inn by Marriott. The pipeline is strong in this market. In addition to their property under construction, the Residence Inn has 1 property in the final planning stages. Once the final planning is complete, the property will move into the construction and development phase. There are 5 additional properties in the market that are in the planning stages. AC Hotels by Marriott is adding 1 new property to the upscale market, and while Marriott has multiple hotels in this market, AC Hotels has not been represented. The Hilton Garden Inn and Homewood Suites each have 1 hotel in the planning phase, and the Hotel Indigo has 2 properties in the planning stage. The room supply in Philadelphia has been steadily increasing. Since 2009, the room supply in this upscale category has risen by 17.4%. If the supply continues to grow at the same rate it has over the past 5 years, the upscale market will have more than 14,000 rooms by 2020. The upscale market represents 26.5% of the total room inventory in Philadelphia. Based on our research of this market, we anticipate that demand will continue to rise. Our team was asked the question, would we build a new upscale hotel in the Philadelphia market? And our answer is yes, we would opt to build a new upscale hotel. We would build in the subcategory of 170 to 199 rooms, and we would ensure that our hotel had meeting and conference space available. We've spent a great deal of time combing through the market data, and we believe that the Philadelphia market is underserved in the submarket of properties with 170 to 199 rooms. In addition to the 170 sleeping rooms for our new property, we believe the hotel should invest in meeting space in order to separate ourselves from our competition. The smaller properties with sleeping room inventory ranging from 141 to 160 rooms have meeting space. However, only 6 hotels in the subcategory of 170 to 199 rooms offer meeting space. We believe the submarket is underserved and expanding. We believe that demand is growing in the submarket. We believe there is a positive long-term outlook. We believe that average occupancy to break even is attainable at 65%. While the average daily rate is predicted to have nominal increase through this May, it's expected to be volatile into early 2016. Revenue per available room is also predicted to be volatile into the first quarter of 2016. Despite the prediction, we firmly believe the submarket remains strong, and we feel this hotel would be a strong investment and it would have the potential to meet the returns our investors will be seeking. In order to generate higher return on equity, a strong EPS, higher net income, and better return on assets, we would need to build the property within the 170 to 199 room submarket. We believe this is an expanding area. At this time, I would like to turn our presentation over to Christian.
Thank you, Sarah, and hello, everyone. I would like to continue our discussion on Philadelphia's market by taking a few minutes to discuss supply, subcategories, market demand, saturation, and the effect of future builds on available revenue. The Philadelphia upscale hotel market currently has 4,474,170 available rooms per year from the 76 hotels. To determine how many rooms a new hotel should have, we divided the market by 8 subcategories based on room count. On this slide, you can see how the 76 hotels fall into each category. Very quickly, the 8 categories and total properties are 70 to 99 rooms, 12 hotels, 100 to 119 rooms, 14 hotels, 120 to 139 rooms, 19 hotels, 140 to 169 rooms, 12 hotels, 170 to 199 rooms, 5 hotels, 200 to 299 rooms, 7 hotels, 300 to 399 rooms, 4 hotels, and finally 400 to 499 rooms, 3 hotels. Each subcategory provides a percentage of market supply. This percentage was calculated by taking the amount of rooms available per year by category and dividing it by the total number of rooms in the upscale market. We used these percentages to determine how much of the demand was met by each hotel subcategory, which in turn helped us forecast the revenue market shares listed in the next slide. In the interest of budget planning, monthly demand was calculated for each subcategory. The average monthly demand for the years 2012 through 2014 was 266,688 rooms. This was multiplied by the percentage of market supply for each subcategory to find the subcategory's monthly demand. The average daily rate for the same period is $127.39. The revenue range for the upscale market is $253,664 per month to $1,282,295 per month. Revenue was calculated per category, then divided per amount of hotels in each category to find the monthly revenue each hotel could expect to receive. The larger hotels may have a smaller market demand, but have a higher revenue potential due to less market saturation and overall room volume. Including our hotel, there are 9 upscale hotels in the pipeline for the Philadelphia market, making a total of 4,839,805 rooms. The future room demand is forecasted at 262,200 rooms per month with an ADR of $127.67. These additions make significant changes to the percentages of market supply and revenue capture for each subcategory. For each new hotel that is added, the revenue capture percentages for current hotels decrease. To decide on room count, we first looked at the room count trend for future projects. However, the trend was in subcategories of 120 to 139 rooms, and 140 to 159 rooms, and they were the two highest saturated areas in 2014 and continue this trend in the forecast. The 70 to 99 room subcategory we felt was too small to host meeting and banquet space that we felt was integral to sustainability. We decided on the 170 rooms. The 170 to 199 room subcategory has room for growth without oversaturating its size market and sits in between two other subcategories, 140 to 159 rooms and 200 to 299 rooms, that both capture future demand of 16.58% and 12.96% respectively. We can potentially draw from both of these subcategories with strategic placement and marketing. Our hotel will be the only new hotel in our subcategory, with an increase in room supply of 62,500 rooms, increasing the supply percentage to 8.03%, an increase of 0.62%. At this time, I would like to turn the presentation over to Hannah.
Thank you, Christian. In this next portion of our presentation, we are going to look at the 2015 forecast of our upscale property in the Philadelphia, New Jersey market. When conducting this forecast, we first looked at the big picture, using the information provided about the current economic conditions in the country, and then narrowed our finding to those that are relevant to this particular market. We then used historical data, examined percentage rates of change, and the total market forecast to determine what our monthly average daily rates and occupancy percentages would be for the 2015 calendar year. The current U.S. economic condition is positive. There are expectations of increased consumer spending as the unemployment rate declines and payrolls rise. There is an anticipation of an increase in business investment and business growth that coincides with an expansion of bank lending to corporate markets. A positive long-term outlook exists for the economy as debt is decreasing and the labor force remains flexible. These economic conditions contribute positively to the growth of the hotel market within Philadelphia and New Jersey. We anticipate many of our competitors to further their development and growth at this time. The expectation of increased consumer spending will contribute to positive demand growth to which the market will respond by increasing room supply. We believe that there will be heavy market saturation over the next several years. However, we also believe that the submarket in which our property exists will give us competitive advantage that would differentiate the property from the total market. As supply meets demand in the total market share, average daily room rates will not hold steady as historical data indicate that there is continuous upswing and downswing movement. Our choice to build a property in a unique submarket of the total market is sound, as the current economic condition and historical data indicate that average daily rates and occupancy will remain healthy over time. The following map is a visual representation of the total market supply increase that is anticipated over the next few years. Again, while there is evidence of heavy saturation, we are forecasting positive outcome by contributing to the current market supply at this time and will therefore continue our plan of property development. The following is an example of a 1-month forecast for our property. We utilize historical data, competitive analysis, and the current economic condition to forecast an average daily rate and occupancy percentage per month. Lastly, we have our complete 2015 forecast for a 170-room property in the upscale segment of the Philadelphia, New Jersey market. Our calculations indicate that our property will have an annual average occupancy of 69.9% and an average daily rate of $127.53. Our annual rates are similar to those forecast by Smith Travel for the total market. However, we are anticipating that the rates will be more consistent than the historically variable rates of the total market. This forecast indicates that our rooms will contribute significantly to the total revenue of our property, which April will now cover in her portion of the presentation. Thank you.
Thank you, Hannah. I will now be covering the 2015 budget for our upscale hotel in the Philadelphia market. Within the 2015 budget, I will be discussing rooms revenue, total revenue, departmental expenses, departmental profits, undistributed operating expenses, additional fees, fixed costs, and a final budget overview. The moving averages technique was used to calculate our budgeted amounts for each account on the income statement and on the budgeted profits for each department. The host report guided our percentages, which are based on both total revenues as well as departmental revenues. Since we are building a brand new property in Philadelphia, we decided to increase departmental expenses and undistributed operating expenses by an additional 5% to account for the first year of operation. As you know, we have decided to build an upscale hotel with 170 rooms in Philadelphia. I will first start where Hannah left off. Our forecasted occupancy for 2015 is 69.9%. Also, based on the forecast, we have decided that our average daily rate will be $127.53 per room. Using this information, we have budgeted for total rooms revenue of $5,528,055 for 2015. To calculate total revenue, we first used the budgeted rooms revenue shown in the previous slide, then built in the rest of the budget based on our calculated moving averages for each account. We are budgeting $5,528,055 for rooms revenue, which accounts for 89.2% of total revenue. Food and beverage revenues total $570,308. Telecommunications revenues are $6,199. Other operating departments are $49,592. Rentals and other income are $37,194. And cancellation fees round out revenues at $6,199. With all of that information, we have come to a budgeted total revenue of $6,197,547. Moving on to budgeted departmental expenses, we expect the rooms department to see the highest level of expenses at $1,713,697, which accounts for 31% of the budgeted rooms revenue listed on the previous slide. Food and beverage follows next with expenses of 79.4% of total food and beverage revenue. Total departmental expenses come up as 35.8% of total revenue at $2,220,763. As mentioned previously, we increased these percentages 5% for the first year of operation of the hotel. We are now looking at the expected profits based on departmental revenues and expenses. The rooms division is budgeted to bring in the highest profits out of all departments at $3,814,358, while food and beverage would bring in $117,483. Telecommunications would see a loss of $16,812 because the expenses are higher than the revenue. Here are our undistributed operating expenses, including administrative and general expenses, marketing, utility costs, and property operation and maintenance. Again, as mentioned before, we raised these expenses an additional 5% from the moving average calculations to account for the first year of operation for the new hotel. Total undistributed operating expenses thus comes to $2,894,254. Additional fees for this hotel are budgeted at $285,087, which includes franchise fees and management fees. Fixed costs, including taxes, insurance, and reserve for capital replacement, total $471,014. This accounts for 7.6% of total budgeted revenue. We are now looking at our final snapshot of our hotel's 2015 budget. We are planning for net income of $326,429, which comes out to be 5.3% of total revenue. Because we accounted for some additional expenses in the first year of operation, We believe that in following years, the hotel could see net income of around 30% of total revenues. This concludes our presentation on building our 170-room hotel in the Philadelphia market. Sarah, Christian, Hannah, and I thank you for your time. We will now take any questions or comments you may have.